See how this holds out here. Okay, cool. I think it should be good. See how this holds out here. Let me mute this. Okay, cool. So, good morning, everyone. Hope you're all doing well. We'll record this here as well. We'll throw up. What are we gonna throw up? We're gonna throw up some charts here. So let me just actually do US 10-year minus US 2-year. Okay, anyways, whatever. We'll throw up a chart here. Perfect. Let me just do this. So let's get started here. It's Monday, June 3rd. Wow. So we've already run through May. On Friday was the last day of May, and what a finale to the day that we had. Markets rallied into the close super, super aggressively. Not many people saw that coming. Everyone was looking at this as a rebalance for the month as we dropped pretty much the majority of the morning session, we can say, some of the afternoon session, and then we just spike rallied into the close. So what a run. Now, the next question as to how things are shaping up is the recessional recovery, right? That's been one of the biggest things over the last, I guess, last few weeks here, because we're looking at, if you look at the treasury yields, right? They've been inverted for the longest stretch on record, with the spread between the US 2-year and the US 10-year, right, the 10-year treasuries, underwater for close to 2 years now. It got everyone worrying about the troubling of a recession. Though many of those calls might have been moderated in the recent months with the US economic expansion continuing, unemployment remains fairly low, and a soft landing increasingly looks that it will be in the cards. So is this an indicator that has predicted every recession over the past 50 years? Is it faulty or broken, or what's going on? We still have a lot of news coming out next week specifically. We have, not this week, but the week after, we've got the FOMC, we've got inflation data. We saw PCE data that came out on Friday, which looked pretty solid. And then we're going into OPEX in the coming weeks after. So realistically, yield curves typically slope upwards. So when short-term yields return more than longer dated ones, it suggests that there is a reason to worry about the long-term economic outlook. So it also signaled that a high level of short-term yields are unlikely to be sustained as growth slows, which can have an impact on a range of assets. So investors usually factor in Fed cuts under those dynamics, with easing expectations signaling the potential for a faltering economy. Now, some think that the yield curve is no longer a reliable indicator, and others point out its stark accuracy. The second to last time the yield curve inverted was in August 2019, which happened ahead of that pandemic-induced recession, and the 2-year, 10-year inverted again in March 2022, just before a technical recession emerged in the second quarter of that year. And any decision on a formal recession is left up to NBER's Business Cycle Dating Committee, which has been responsible for setting the dates of peaks and troughs of the U.S. economic movement since 1978. But since it was never formally declared, it kept investors waiting for another one to happen. So the Fed's infamous transitory, right, call of inflation, a stock rally that has confounded Wall Street, and most recently expectations of rate cuts, are all among recent predictions that have led many investors astray in the recent years. Now, economists Let me just move up here like this. Economists and mainstream analysts have to check their report cards, and the recession talk might be the next failed project. And is it different this time around, or is a recession bound to happen eventually in due time? Now, we've been seeing a lot of this upside in these markets. We're in a pretty strong bull. You can see that every dip gets bought up, and what a dip got bought up on Friday. We're still in a position where things are looking to climb higher, and I think that those rate cuts, right, a flurry of them might be one of the things that kind of sparks that downturn. Now, is it an inevitable thing? Maybe later than sooner, right? A lot of people have been trying to call this top and a massive market crash for what seems to be months now. Now, let's dive into GME, right? GME up again, right? It was at one point up about like 90%. Right now, maybe it's closer to up 80% pre-market, and a lot of volatility after influential trader Keith Gill, known as Roaring Kitty, revealed what appeared to be a big stake in the company. Gill, who sparked the meme frenzy in 2021, apparently shared a screenshot of Reddit that showed he'd bought millions of GameStop shares valued at around $116 million, as well as call options, and has prompted a broader rally for the meme stock this morning. GameStop also soared last month after Gill returned to social media following a 3-year hiatus, which was enough to ignite a crazy buy move in the stock that more than doubled in May. Now, a lot of people are kind of guessing around the fact that he probably just sold his Twitter account and someone just been playing around with that. But again, we've seen this meme craze spike up yet again here today. Options are probably going to be extremely expensive with IV, and there's probably going to be a lot of trading around this name today. So all those stock traders and option traders might want to look at these meme names. So what else do we have here in terms of news, right? Crude oil, oily. Let's put it up on the screen here. So a bid to boost oil prices, but didn't really have too much an immediate effect recently, as OPEC Plus has agreed to extend most of its production cuts well into 2025. And the group had previously slashed supply by a combined 5.86 million barrels a day, of which 3.66 million barrels per day were due to expiry at the end of 2024, and 2.2 million barrels per day voluntarily cut by 8 members were set to expire at the end of this month, while many OPEC Plus members reportedly need oil prices to be above $80 a barrel to balance their budgets, and some analysts say that the decision was bearish, giving a recent increase in inventories. Now, I've been liking oil a lot this year. I still do like it. I think that this is a higher low pullback in the grand scheme of things, right? I'm still looking at these areas as long as we can kind of hold out around 74 to like 77, and show some kinds of bottoming in crude oil. I think there is a potential to find this bottom to swing it back up towards the end of the year, and following through with that, right? Commodities are on a nice little uptick here. They're into a cyclical bull right now, and I do still like commodities as well as oil, just trying to find where that bottom might be in the recent weeks, right? In these coming weeks here. So in terms of news, we don't have too much. PMI manufacturing index today, ISM manufacturing and construction spending at 10. And then coming throughout the remainder of the week, we have non-farm payrolls on Friday. Other than that, it doesn't seem like there is too much this week, at least, to shake and stir markets as we wait for Jerome Powell and the Fed, along with some other news, and not next week and then the week after, realistically. So another thing, right, that has been helping these markets a decent bit has been Nvidia. As of recent, you can see it's gapping up very viciously yet again. Surprise, surprise. So we got a decent pullback over the last 2 trading days, Thursday and Friday. But right now we're gapping back above the prior the Friday highs, I should say, right? It didn't really quite rebound that aggressively along with the triple Qs on Friday, but right now we're gapping up pretty aggressively, and there is still some upside momentum on this. Triple Qs with Nasdaq gapping up aggressively as well above those Friday highs, and there could be a little more potential to the upside. Right now, with that rally on Friday, I am still looking for some kind of bullish momentum. Take a look at the S&P 500. Quickly here, we'll take a look at the SPOOs on the futures front, right? If we look at maybe like a 15-minute chart, I'm still bullish above like 53.04 realistically. To the upside, we can target that 53.25, and then we'll kind of see what happens there. The bears, they're not really that strong and great until we start breaking back below this 52, 92, 95 area. Otherwise, right, there's still bullish momentum on this. You've got those distribution areas above. We're sitting in a new distribution to the upside. So as I'm looking at this and as the auction holds, I'm still looking for some of that upside continuation, unless, right, we see some breaking down to the downside. So we'll look for some of the upside today, right? Until these areas are broken. I don't want to get too bullish. I don't want to go like crazy with it, especially with that rally that happened on Friday, right? A lot of people are looking at this and thinking, oh, well, shit, okay, it can't continue to go much higher. But until those distributions break, they're expected to hold. So I'm still looking for some of that upside continuation to bring us home. So with that being said, I hope you guys have a great trading day. It is Monday, right? Let's start it off a little slower, especially after Friday's frenzy, and ease into the week as we've got a full week ahead of us in terms of trading. So thank you guys for watching on YouTube. We will be back tomorrow and the remainder of the week, and I'll chat with you guys soon. Let's open up our live trading room here for our folks at TRADEPRO Academy and see what we got cooking for today. I'm mainly going to be looking a lot more at the S&P 500 just due to some technical issues that we might have found here. And I'll see you guys tomorrow. So let me